Hello everyone, and welcome to what we anticipate will be a lively and insightful discussion on flood risk as a measure of asset value, hosted by Fathom. I'm Karina Vaughan, and I lead on climate risk in financial markets at Fathom. And I'm delighted to open this event and thank you for taking the time to join us today. For those of you who don't know Fathom, we are the leading provider of high-resolution flood risk intelligence worldwide under any climate scenario. And we work with climate risk leaders to help them to understand and to mitigate risk from flooding to critical assets and to high-value portfolios. Climate risk has become an important subset of environmental risk within the ESG framework. But whilst useful, ESG scores are not risk measures. And so as we seek more and better ways to align climate risk with financial risk, flood risk is emerging as a key measure in portfolio screening, due diligence, regulatory reporting, and in stress testing. And this is perhaps unsurprising, given that flooding is the costliest and the most devastating form of natural disaster. And indeed, our research at Fathom shows just how great its impact can be. So one piece that we published earlier this year actually demonstrated how the failure to adequately price and account for climate-related flood risk threatens the stability of the entire financial system. So could flood risk therefore become a dominant metric in assessing the potential financial impact of climate change? Could it become the most important measure of asset value? Well, these are all questions for our amazing panel of experts led by Fathom CEO Stuart Whitfield. And we'll capture outputs from this session in a short paper, which we'll share with you later this month. So please do ask questions, and we'll try to get to as many of those questions as we can. And I will now hand you over to Stuart to get the discussion started.
Well, hello everyone, and thank you, Karina, and welcome to everyone who's joined the webinar and to our panel. As Karina said, over the course of the next 50 minutes or so, we hope to have an insightful discussion on the impact of flood risk, both present and future, on asset values. And before getting into that, just a few housekeeping points from me. First, I'm going to ask each of the panel members to introduce themselves, make a short statement on the topic in hand, and give their particular perspective on it. Please do note that the opinions that they'll be expressing will be their own and not those of their respective organisations, unless, of course, they expressly say so. After those introductions, we'll then have the panel discussion itself, which I'll do my best to facilitate. Apologies in advance if I cut short any discussion point at any particular point, as I think everyone appreciates the subject matter we've got here is multifaceted, and any one of the subpoints could easily form the subject of a webinar of its own. But we'll try and cover as many angles as possible. There'll be some time for questions at the end, and as Karina said, you can submit questions into the webinar question sort of chat area as we go through. I'll do my best again to try and weave those into the discussion where I can and where it's appropriate to do so. And finally, as Karina mentioned, we'll try and capture the key points from the discussion and follow up with a short white paper after the webinar itself. And so with no further ado, I'd like to introduce our four panelists. They are Brianne, who's Head of Geospatial Analytics from Morgan Stanley, Gillian, Vice President at MSCI, Sam, Business Insights Specialist, ESG Data and Analytics Enablement at TD Bank, and Andrew, Head of Climate Risk North America at Tata Consultancy Services. They'll each introduce themselves, setting out their role and experience, and provide some perspectives on how flood and climate risk factor into their current business operations and those of their clients. So, and I haven't discussed this with them in advance, so apologies for the short straw, but Brianne, if you'd like to go first, please, over to you.
Hi, excuse me. I'm Brianne Hendrickson-Smith. I work at Morgan Stanley in our Global Sustainability Office, which is a centralized sustainability function across the whole firm. And I specifically focus on geospatial data. And so physical risk is generally a spatial data format or a spatial risk. And my background is actually as an academic and a hydrometeorologist. So I used to research urban flooding as well. And sorry, Stuart, was there a second part of that I should answer?
Yes, the second part of the question, the second part of the introduction is there anything you'd like to say, just part of an opening introduction in terms of your perspective around the subject area we're about to talk about, which is the impact of flood and climate risk on asset valuation? There's a whole bunch of detailed questions we can get into, but if there's anything you'd like to open up with there before we move on to the next person, that'd be great.
Sure, I guess I would say it's very hard, but very important, right? And so I think it's not solved yet, and we're all just working our way towards figuring this out.
All right. Thank you very much, Brian. Over now to Sam, please. If you'd just like to say a few words about yourself and similarly anything you'd like to say to set the scene.
Absolutely. Thank you, Stuart and Karina, for the introduction. My name is Sam Cherniak. I work on building the climate data solution here at TD Bank. So as financial institutions are becoming required to report their physical and transition risks and other climate risks to federal bodies and to shareholders, we see the need for an internal solution to understand these risks, this data internally and externally, and how to bring it all together. Flood risk is a particularly important risk to anyone owning or lending to physical assets. Flooding is one of the most, the biggest dollar value risks for physical assets like mortgage portfolios and commercial real estate and lending. So it's very important to understand the different risks. I think between flooding, wildfire, convective storms, they're all quite difficult flooding and wildfire are quite difficult to get a handle on. And it's very important that we understand the different scenarios and factors at play when we're considering flooding to physical assets and how that translates to metrics that are important to the user's dollar values, probability of default, things like that.
Okay, thank you, Sam. We'll touch on and get into a whole number of those areas in the course of the next few minutes. Next, could I please pass over to Gillian?
Sure. Hi, everyone. I'm Gillian Malad. I'm a vice president at MSCI. My background is also in geospatial analysis and also in environmental science. I've been with the firm for 5 years. I started on the ESG ratings model and R&D team. And my focus there was bringing more geospatial analysis into our overall research. And about 1.5 years ago, I joined the MSCI Climate Risk Center, but in New York City. The main risk center is in Zurich, but we started an offshoot in New York City. And I'm a physical risk researcher there. And in this role, I focus on applied research, content creation, and enhancements to our physical risk model, which is part of our climate offering. We look at 10 different hazards. Of course, that includes flooding. We look at coastal and fluvial flooding. And our model takes a bottom-up approach. So we start at the asset level, and we use information about the asset to derive damage functions and financial exposure. And then we aggregate that to the company level. And in terms of just something to say about flooding, it's the costliest natural disaster. And the floods that we're seeing today are not the same ones we saw in the past, but we still rely on a lot of historical data to determine how much financial risk is exposed at each asset. And so that's something that needs to change. We need to better understand what the floods of tomorrow will look like.
Absolutely. Thank you, Gillian. And last but by no means least, Andrew.
Hi, Stuart. Thank you so much. So I'm Andrew Isle. As you mentioned, I lead the climate risk advisory practice in North America for Tata Consultancy Services, or TCS, which is a global software and IT solutions firm that has particular expertise and leadership in the systems integration as well as financial advising space. I myself have a background in climate policy and markets. I've spent much of my career in international development, in climate finance, and joined TCS at the beginning of 2022 to build out this climate risk advisory practice. catering to financial sector clients, and in particular the risk management function, and seeking to integrate climate considerations into both financial risk management as well as operational risk management. And just a reflection on flood risk, I think that it really is, in many respects, a microcosm of the broader issue of climate risk. It encompasses both financial as well as operational risk. It has both short-term as well as long-term considerations, both acute weather-driven impacts as well as longer-term chronic impacts related to changing precipitation patterns, sea level rise, et cetera. And there's also a lot of interesting dynamics around asset level assessment versus portfolio level assessment. And depending on the questions one's interested in, which kinds of tools and metrics, whether quantitative or qualitative, say for scenario development, are most appropriate and most useful for considering flood risk impacts on asset values. So this is a very rich topic. I think we'll be challenged to deal with all those things in 60 minutes, but very excited to dig in.
We will indeed, but that's the gauntlet that's been thrown down. So we'll do our best. I thought what we do now is sort of have a sort of get into a general discussion first around kind of current flood risk, talk then about climate and flood, then have a more detailed discussion around the use of flood and climate data in valuation and pricing, and then sort of finish with talking about longer term trends, drivers, the future, a little bit of the more less concrete stuff perhaps in the moment. So I'd like to kind of start off by asking, to what extent do each of you see businesses, whether your own or your experience more generally, factoring in flood risk data within their assessments of asset value? Who'd like to start with that?
I'd be happy to start with that.
Oh, thank you.
Yeah. So most of our clients are institutional investors, so asset owners, asset managers, and a lot of them are trying to understand, the climate risk within their portfolios. So looking at how companies are exposed to flooding, and trying to understand like an overall global picture of where companies are located, where's the areas where maybe flooding is happening more frequently. And also, we have at MSCI, we have a real estate or real assets department, and they're very focused on, and its focuses mostly on commercial real estate investments. And they're very focused on flood risk at the asset level. That's probably where we have the most interest in flood risk at the asset level. We also have interest from insurance clients as well. But we see the strongest sort of interest in flood risk at the real estate, and then overall climate risk as well.
Thank you. Anyone else like to add to that? Sam, Brianne?
Sure, I can say a little bit. I think that from my perspective, it seems like the biggest interest in flooding right now is from a risk perspective. I think Andrew and Sam both brought that up a little bit in their introductions, right? And so I imagine over time that should filter into pricing, but from my kind of, 5,000 yard view of what I see, it seems like the biggest driver right now is really the risks associated with flooding, probability of default, loss of value, but I don't know how much it's priced in yet.
No.
Yeah, I think.
Sorry, go on, Ed.
Yeah, no, I think as we see a 1 in 100 year become a 1 in 20 year flood, it's become a big issue. And then, I think currently, to Brianne's point, I think right now it's probably being more factored into determining insurance premiums as they sort of refresh their premiums yearly, and understanding how that 50-year or 100-year flood changes. We see that coming in. But in terms of assessing loan risks in flood-prone zones or determining real estate pricing, I don't know if it's fully fleshed out as it could be. I think we're starting to see, like in Canada, there are flood-prone zones that are being zoned out for residential or any building because they see so much flood risk there. So, it's having effects already. but is it fully priced into risk for large asset owners? You know, it's hard to say. I doubt it.
Okay. Okay, and Sam, anything from you on this?
I'm sorry, Stuart, did you mean to hand it to me?
Yes.
Okay, sure. Thank you. So building on what Brianne and Sam said, I think it's a mixed picture right now, because on the one hand, there are academic studies that I've seen and policy white papers that suggest statistical analysis of the residential real estate pricing space indicates that there are statistically significant differences in pricing of flood-prone versus non-flood-prone areas, particularly along the coasts, at least in the United States. However, that doesn't necessarily translate into asset values across entire regions. We've seen the Sun Belt, the South and Southeast areas that are among the most flood-prone in the U.S., or even the Northeast, have very high asset value appreciation in the residential real estate space. So it's a mixed picture. I also just saw a few days ago a Zillow survey saying that 3 out of 4 home buyers in the United States are considering climate impacts, of which flood is a significant component. So I think on the one hand, there's this awareness, right, that the risk is there. But I would very much agree with Sam and Brianne that it isn't, translating directly into pricing necessarily. And I think that is really a challenge, is thinking about, well, how do we take this qualitative information or risk information, which is about probability distributions, right? It can be very hard to conceptualize that as a consumer, as a buyer, as an asset manager. How do you actually translate that into decision relevant information and into impacts on asset values? And it's a really interesting challenge, and I think the space is evolving quickly.
Yeah, I'd agree with that. I mean, how are you seeing flood risk currently being measured from your various viewpoints? Andrew, do you want to continue, as you were the last to speak?
Sure. So at TCS, we work with different types of financial institution clients. So we have clients in banking, in insurance, in asset management. And of course, each of those is looking at this a little bit of a different way. I think for asset managers, there's often, this focus specifically on pricing in the end, right? Whereas, as Sam mentioned, in the banking sector, it's often more of a consideration of probability of default, right? And what does that causal chain look like that leads from climate impacts to damage function to financial distress for a borrower, an obligor, and then to probability of default, where that then impacts the lending institution. And so there are a lot of assumptions and calculations and assessments that go into each of those links in the chain. And I think getting to the point that Jillian was making about whether you start asset level or whether you say have a top-down approach that maybe considers macroeconomic or community level impacts. You really can have different pathways for the transmission of that risk based upon a flood event, right? And so there's really a lot to unpack, and so I think it really is very use case specific, and in many cases also location and asset class specific as well.
Yeah, I think that's right. And who else would like to come in on that? I'm particularly interested in in people's perspectives on the extent to which asset level information is A, available, and B, useful, and I guess C, scientifically valid. But we'll leave C out of the question for now, because otherwise we'll go down a rabbit hole we probably won't escape from. So let's talk about that. Let's other perspectives on the extent to which asset versus portfolio level information is around and what can be done with it.
Yeah, I think that there is this issue sometimes of how good is your flood data, but at some level, is it really worth going into, high detail, good flood data if you don't even know where your assets are anyway, right? And I think what we realize is that it's really dependent on the end use case. And so if you're just trying to, at some like high level, compare two portfolios, maybe some of these like 1 to 100 scores from a climate model are sufficient. It's not so hard to say which properties at a broad level are like in trouble from coastal flooding and which aren't. But then if you're getting down to specific mortgages, you probably want empirical data, CAT model data, really specific data when you know where the building is, maybe even a little information about the building, though that would be a lucky case, I think, right? But yeah, I think it's a constant trick to try to like figure out, okay, how much information do I even have? What's the right solution for this situation? And there is no easy, straightforward answer, I think. And yeah, often the asset information is missing or very incomplete.
And is that something, Sam and Gillian, you see echoed in your experience and work?
Yeah, absolutely.
Okay.
I think, sorry, I think the use case, it determines the sort of level of granularity needed. If we want to do a hotspot map on a portfolio and understand general areas where risk might be higher and have a bit of a warning there, understanding there of the risk, then less granular ratings methods are required. So just understanding the general, maybe whether it's changed from a given historical period or whether it's just a score, that could be helpful. But I think what it really comes down to is with these physical perils, understanding from the bottom up is pretty necessary, even to get a better picture at such a course level. If we want to understand the risk to an institution, to its liquidity or credit risk, then I think it is still important to have that granular information and roll it up to those levels. That I don't think that anyone's going to be adjudicating a mortgage based on their individual flood risk, but I do think that if we have that granular data, then we will get more accurate values when we roll up to, maybe you focus on an area with higher general risk than from a hotspot mapping exercise, and then to understand credit risk or another parameter like that.
Yeah. All right. Yeah. Thank you, Gillian. Anything from you on that?
Yeah. So part of our like climate value at risk model that we have at MSCI kind of it relies on asset level data. So we start at the asset level, and we take the financial metrics at the issuer level and we disaggregate it to the assets that we maintain in our asset location database. So we do have a database of assets, and it's not perfect. Corporate disclosure on locations is pretty poor. So we have a team of manual collectors, and then we also use vendor data sets, and we also use regulatory data sets. So we have a whole combination of data inside of our database. And so what we do is we look at the size of the asset and the asset activity and the country where it's located, and we use existing financial metrics on what the average square meter of a site of a building of that type costs, and we incorporate that into if there's asset damage. So we kind of bring that into our damage functions. But I think the main sort of issue with deriving a product at the asset level is the limitations in the asset level data. It's not perfect. So, I think we also see the need for regional level hazard metrics. And one of the things that we've been working on recently is a regional hazard metric that only looks at the exposure to the climate hazard. So it doesn't look at the financial exposure at the asset level, but rather just, how exposed is that area of the globe to this hazard? And we look at that for different time periods and different scenarios.
Yeah, I agree.
So I think that I would say that a lot of clients are interested in, one or the other approach or both approaches. You know, if they have private assets, they want the more regional approach so that they can go in on their own and determine their own exposure at the asset level using their own models and financial information.
Yeah, I agree. And
But I think it is sorry, I was
Sorry.
just going to add, I think it is essential to have asset level information to be able to truly understand the financial exposure at that asset level to flooding.
I think that's right. And I think, building on your point, it's also important to understand and to communicate the range of uncertainty associated with the data available at asset level, because there's providing people with the false comfort of an absolute score, and we'll come on to scores and the use of scores in a little while. I think can be, if used in the wrong way, can actually be really quite misleading. So I'd like to turn now to the impact of climate risk on physical perils, and obviously particularly on flood. What are your views? And this again is a rather open-ended question, but what are your views on how climate risk is currently being measured and then impacting upon physical risk? That's a nice easy one. So who'd like to start with that?
I can start, I guess.
Yeah, thank you.
I feel sometimes like I'm a professional naysayer, right? But I think that the tricky thing with flooding in particular, this is more true of some hazards and less true of others, is that it's a secondary peril. So things like, as a former urban hydrologist, impervious surfaces might be more important than the climate changing, right? And so I think absolutely we need to include impacts of the climate changing, but that is nowhere near a full picture of what we should expect in 50 years or 100 years. And so maybe someday someone will have like impervious surface projections that can be folded into these models, or urbanization projections, but it's very hard, right? And I think people are starting to approach it in ways that make a lot of sense, but it is not a complete picture yet.
Yeah, agree. What do others think? Gillian?
Yeah, I mean, I agree with what Brianna said, and there's a lot of uncertainty in climate models in general, and I think that that's something that we're grappling with, as a whole in the climate realm. And what I mean by that is, the climate models are essentially predicting the future based on the different emissions trajectory that you follow, like basically the scenario that you follow. And while the science behind it is valid, there's a lot that we don't know, and we don't know how adding all these greenhouse gases to our atmosphere, like we have a sense of what will happen, but we don't know exactly what will happen. We don't totally understand the tipping points. So there's a lot of uncertainty, and also there's a wide range in the probabilities that we use. So I think it's like essential to sort of just understand the limitations in climate modeling. I think, we also can't rely on reanalysis or historic models, because, like I said earlier, we're seeing the climate play out in a different way than we have in the past. And so, I think that's sort of one of the things that I grapple with. In terms of flooding, I think the biggest issue there tends to be understanding the topography of a region, as Brianna was talking about impervious surfaces, but also, you need your base data of where your asset is located vis-a-vis sea level. It needs to be well understood, and sometimes the data there is limited. And for global flood models, the resolution is often not as granular. So yeah, there's a lot of different limitations, but understanding the risk of your asset is highly important. So yeah. The data is necessary, even if it has its flaws.
Thank you. Andrew, what are your views on how climate risk is currently being measured and used in relation to physical perils?
Yes, well, so I'm very sympathetic to Brianne and Gillian's perspectives on many of the uncertainties, right, that do hamper some of our forward projection abilities. I think it's important to draw a distinction between longer term future perspectives and nearer term. So time horizon is really important. Are we trying to assess the vulnerability of an asset for the climate of some time in the future, or are we trying to assess the current or near term exposure, right? As Jillian was mentioning, for the future, those scenarios are fundamentally dependent on emissions pathways, right? And how one then translates emissions pathways into warming and to weather, precipitation, and sea level rise. That stuff is hard, right? There are a lot of people who do that very well, including you guys, in particular. But there are some, I think, uncertainties there, and those to some degree are just the nature of the beast and are hard to eliminate. There are other questions, I think, around the near-term exposure to flood hazard that are more a question of exposure to high sigma events, right? So tail risks and extreme outcomes. And we've seen so many instances in so many locales of unprecedented flooding just in the last year or two that I think there's a real reason not to lose sight of the imminence and materiality of those climate impacts that are already here, essentially, right? And trying to understand, given that the past is not a predictor of the future, just because a particular location has not had a devastating flood event to date doesn't necessarily mean that it couldn't, right? Even in today's climate. And so I think that even sort of short-term or near-term risk assessment is also really important, and thinking about how climate has impacted that is something that really deserves a lot of attention.
Yeah, I think that's right. I think one of the facts that we've published papers on, and it seems to be one understood, is that the climate change signal, important though it is in the short term, is outweighed by just demographics and human behavior. People still like to settle in places that are at risk, and the increase in risk is often driven by those factors rather than climate, certainly in the short term. Sam, anything you'd like to add to this before I move on to develop this in a slightly different direction?
Yeah, I mean, some excellent points covered. I think I'll just reiterate that, in the short term, the metrics are more about adaptation, and the historical flood data, is not helpful for our future projections. And from an engineering perspective, if we're building a new asset, what do we design to? And that becomes the tricky thing as well. Like, if we're building a 50-year asset, which scenario do we consider? And there's uncertainty there, and there's uncertainty within the data and then within the scenarios themselves. And it's not a simple issue.
Yeah. And what is it that's, I mean, there is an increasing demand for climate risk intelligence in its broadest form. What do you think is driving that? What are the key drivers there? Is it regulation, investors, lenders, other factors? What are the key? Because clearly the things that are the key drivers there are the ones most likely to shape the form in which that intelligence then gets created and delivered. What are the key drivers there? Sam, you got any thoughts on that?
Yeah, I think it really started with the TCFD and the investors demanding change, and then the regulatory bodies have followed that, both in the US and Canada, and then Europe a bit ahead of us, and the UK ahead of us. It was the investors ramping up the pressure on institutions to assess and disclose these vulnerabilities on flood risk, and especially after lots of high-profile flooding events in recent years, investors are becoming increasingly aware of this. And also, large asset owners are wary of their assets being stranded due to recurrent flood events. So these assets can lose value, and on top of that, we can have these tail effects, as Andrew mentioned, where the neighborhoods are affected, operations. We have loss of access to financing potentially. All of these large, broader effects that come from one single flood event.
Yeah. Anyone else?
I'll just add that, as Sam said, regulation is really the main driver that we see. Then we also see interest just in generally a better understanding of climate risks within a portfolio. But a lot of the initial interest in, looking into climate risk is regulatory related, at least nowadays that we're finding more and more of that. But yeah, the TCFD is definitely, the launching pad of investors getting interested in having more data around climate.
Yeah. Andrew, Brianne, anything you'd like to add on that?
I guess also, I mean, this year it's just the news, right? It's just something, certainly the kind of requests I see are often responsive to the news. So right now we're talking about hurricanes. Earlier we were talking about wildfires, and just seeing insurers start to pull out of states. And I think it started probably with regulations and regulators and moved on to investors. And now I think it's just a broad recognition that these are going to be financial impacts, and it's not just about, this nebulous idea of climate change, but it's really happening now.
Yeah. Okay.
I would really agree with that. I think that there's also a recognition of some of the interlinkages between climate risk and the demands of the TCFD and certain regulators for disclosure, as well as other types of risk management. So, for example, we at TCS have seen a lot of interest in the operational resiliency space to begin to consider climate impacts for disaster planning and contingency planning, business continuity, those kinds of things. Some of that has its own set of regulatory drivers, whether they're financial regulators or other regulators. But we see a convergence in that space. It's also, I think, worth noting that the emergence of scenario analysis and stress testing is also an important area. That, of course, is not distinct from the TCFD by any stretch, right, or regulatory requirements in many jurisdictions. That scenario analysis piece, that resilience to different scenarios, is part of the strategy pillar of the TCFD framework. But I think we're just now starting to understand, as these flood events have proliferated, the ways in which floods can be a trigger for more complex events, right? Whether they are, as Brianne was saying, the pullout of insurers from individual markets, right? Where perhaps they're no longer providing flood insurance or kinds of homeowners insurance. And what are the impacts then on mortgage lending? What are the impacts on property values? What kinds of impacts do you see as flood risk events can potentially cause supply chain disruptions? And I think it's often difficult to quantify those in a simple way, which really requires narrative-driven scenario analysis to really kind of tease apart a lot of these different aspects of perils and hazard events. And then, once you've kind of worked through the causal chain, then you can quantify on the back end what kinds of impacts would you expect to see, and how do you turn those into dollars or other risk metrics on the back end. But because of these complex effects, it's often important to consider those complex scenarios that think about systems, in addition to the asset level assessment that, of course, is critical as a bedrock risk assessment tool as well.
Yeah, no, I agree. I'm looking at some of the questions that came in. There was one here, and I think I'll exclude Gillian from this one unless she'd like to answer it. But it's around the fact that we've seen in the last few years quite a growth in the creation of both climate value at risk platforms and climate ratings platforms and organizations offering those kinds of things. What thoughts do you each have on the complexity and some of the issues around the buy versus build dilemma that organizations that need this data have to face? Because it's tempting to buy to license an all singing, all dancing platform, but how do buyers go about actually working out what data is actually out there that can add value to their businesses? Again, another easy one for our panel here. So Sam, would you like to start off on that one? You've had the least thinking time, so
Yeah, no worries. It's something I'm very familiar with.
Yeah, I thought.
So, some of these solutions are quite expensive to buy, and they're yearly subscriptions, right? And but the flip side is having the internal capabilities and having climate scientists or people very familiar with climate data itself. Climate data on its own is a very complex thing to understand, and fitting that all in to a large company's framework for data and analytics, and building on top of that data, selecting the correct data, building these models. It's not trivial. However, if you have 5 different providers that are costing you $1 million a year, you have to do that balance. But I think, building internally may provide some long-term cost savings, but it is quite difficult to do right. And if you have someone, an outside provider who's a specialist in a certain area, with a proven track record, I think that's something that you can't really leave out and have to consider. But
Yeah.
it's tricky.
Yeah. Brianne, what are
Yeah.
your thoughts on that?
Yeah, it's really hard, I guess. I think this is a weird world where a lot of the data sets that are feeding everyone's, data or data products are free. But the work is in translating complex file structures, really big files, into something usable to people who tend to like to see Excel spreadsheets, right? And it's a lot of work. And so there's this question, I guess, of like, do you put the resources into doing that internally, which will take a lot of time also probably? Do you buy something external, but then you don't have as much control over which inputs they choose? And then there are some things like asset data. There's no open source asset data, at least that I'm aware of, that you need to figure out anyway. And so, I think I've tried to understand, like, what are all the data sets we would have in a perfect world? And there are, probably hundreds, right? And so then prioritizing, well, what's easy, what's hard, what do you buy, what do you not need to buy? But also, how do you answer requests today and not in 10 years when you've dealt with these hundreds of data sets, right? So it's hard. And there's also this problem that, the landscape's constantly changing. So even in the past few years, startup climate data companies are getting bought by bigger companies, and CAP models are getting bought. And it's hard to even keep up with all the changes, let alone, make decisions about what to do in the next several years. So yeah, it's really complicated, I guess. And I think a lot of it will be determined by, the size of the organization and how specific data you need. If you can answer specific use cases, it's probably a lot easier to do it on your own.
Yeah. Andrew, what are your thoughts around this?
I really like that Brianne mentioned challenges around asset data that are needed regardless, because I do think while it is a critical and difficult question, the sort of buy versus build, in some cases it can be a false dichotomy in the sense that you need both. At TCS, where we do a lot of work with clients around systems integration, basically helping them to advance their own internal IT systems to really generate the decision relevant outputs that they need. Not only do you have the decision engine piece of that, but you have the data sourcing piece of that. And you have the external data, which may be the climate or weather data from a provider. But there's no substitute for the internal data that for a financial firm or other firm needs on its own assets, right? And its own clients, for example. And we find that there are a lot of barriers to even, accessing, aggregating, ingesting that data from internal sources that is really critical to best leverage and make use of that external data, right? Otherwise, you can have garbage in, garbage out, or you can just have major gaps, right? Where you have an incredible analytics provider but you don't know how to apply that to the assets you have, or your systems simply aren't capable of really facilitating that. So all that is to say that I think it's more of a both and than an either or. If it's any consolation, I think to audience members who may be at earlier stages of their climate risk or flood risk journey, I don't think that you have to swallow the elephant in one go. I think there are a lot of incremental steps, both on terms of internal data and internal assessment, as well as sourcing this data externally, that can be really lead to step change in quality without having to sort of tear your hair out trying to make deep kind of path-dependent decisions, expensive path-dependent decisions about buy versus build. I think one can take incremental steps in both directions, and that is really important towards improving intelligence in decision making.
Thank you. I perhaps unfairly excluded Gillian at the beginning of this question. If there is anything you'd like to say, Gillian, because
yeah, actually, there is a couple. Yeah, I agree with a lot of what Andrew just said. That it's rather than being an either or, it should be really an and. We have a lot of clients who will build their own internal systems, and then they'll use some of our data and kind of mix and match. I think one of the problems that we run into is when we have clients who sometimes take our data and they take data from 6 other providers, and then they compare them, and maybe the data isn't derived the same way or the models are different, and then we get you're comparing apples to oranges, and they're like, well, why does this say this and yours says this? And it's like, so I think the real main thing is understanding the data that you're getting from providers like MSCI, like really understanding the in-depth. And actually, that's one of the things that I'm working on, is making some of our more complex data sets a little bit more easy to digest for clients. So I've been doing a lot of trainings for clients recently, just to make things a little bit more understandable, because most of our physical risk team are PhD scientists. And I think one of the things that's interesting about that is, 20 years ago, if you were a PhD scientist, you mostly, stayed within academia or, maybe a scientific organization, but it was very rare to find jobs in the private sector. And now, with climate science, there's a lot of PhDs who are able to get different jobs, and it's, it's an exciting time in that sense. But we really think it's important that the data that comes out of our models is peer reviewed, scientifically vetted, etc., and that it's really just top of the line research, because if not, then you're working with data that's not correct. So like the garbage in, garbage out, I think somebody said, yeah, that's a big deal. And we do find that one of the issues with limitations in our asset database is that often that leads to wrong information coming out if the asset data isn't accurate. So yeah, that's another hurdle to always ensure accuracy there.
No, thank you. And you're absolutely right about the value of taking multiple views, and it's something that's obviously very common in the insurance industry, where people take ensemble views using multiple models to reach conclusions. So let's, assuming everyone has now both built and licensed their All Singing All Dancing data platforms, now looking at the actual use of the data that those platforms can be put to in terms of valuation and pricing, do you find, well, first of all, broaden it up, what challenges do you currently encounter in actually translating even the best data that exists out there, particularly obviously Fathom's flood data and climate data, into actionable insights that you can then use in valuation and pricing and the other ways in which you're going to use it? Sam, do you want to start on that?
Yeah, absolutely. I think that the whole idea of impact functions or damage functions, or translating 0.5 meter flood into a dollar value for an asset or a portfolio of assets, is the secret sauce right now. Getting an accurate model that's applicable to your portfolio, I think that is very difficult, and that is the biggest issue we see right now in the industry. There are some flood models that are general, some damage curves that are general, However, I don't think they're appropriate for every scenario and fully vetted. I think it's that right now is the most difficult part. And part of that stems from, every neighborhood is different. Part of that stems from, we've spoken as, of flooding as broad, like a broad category, but flooding is, multiple different, very specific things. We can have, urban pluvial floods. We can have fluvial floods from snow melts. We can have them from, human caused dam bursts. Flooding is not one peril. Flooding is many different perils. And I think it's very difficult to translate all of those to a direct dollar value impact or a direct risk metric that will allow for easy decision making. So I think it's that right now is the difficult part.
Thank you. Do others agree with that? Would like to expand?
I'd go even a step further and say, damage to the building isn't the only cost, right? Then you have business was shut down for a week because the building is fine, but the street was flooded, right? And then beyond that, you have, well, now, like, how does the market respond to that? And so I think it's like an infinite number of issues piling up, right? And so if we have our perfect flood data, our perfect asset data, the next step isn't easy either, unfortunately. But I think Andrew was saying before, even if you're just getting started, you could end up in this loop of you can't possibly know all of these things, but it's always worth just making improvements, right? You don't have to be perfect. Is it better than what it was before? And keep going with that.
Yeah, we believe in OODA loops and constant incremental improvement. It's the only way to do it. As many people have said before, all models are wrong, but some models are useful, and our goal is to make them more and more useful as we go on. So fairly obviously. Gillian, how about you? How useful is this stuff?
I mean, it's sort of the bread and butter of what we do. But yeah, it's not a perfect science, and we're highly aware of limitations. And having all the information that you can at the asset level is really like a good first start. Understanding how much the asset is worth, how much, if it's a revenue generating asset, what's the revenue being generated there, and then in terms of damage. And I do agree with what Sam said. Sometimes the flood data is clear, but you don't know what the damage functions are, or as Brianne mentioned, the business interruption. So we have metrics to measure that, and we use studies to derive damage functions and business interruption functions. But they're not always perfect, and we're highly aware of that. One of the other things I always like to kind of point out in terms of asset level data limitations is with flooding is, we hear a lot from clients who say to us, what about protection levels? Do you have good data on protection levels? And, we have some regional protection levels that we incorporate into our models, but most of that is pretty it's national or somewhat subnational, but it's not very granular. And flooding risk is a very granular metric, and it's really specific, not just to a region, but like the geography of the spot where you're assessing risk. And even if there is flood measures in place, if an asset has flood protection, but the area around it is flooded, then it doesn't matter that there's protection there, because there could still be broader economic implications if the supply chain is disrupted or businesses shut down.
Yeah. I'm just conscious of time now, and I want to try and give a little bit of time to some of the questions that have come in. We've answered one way or another some of these, but I'll just put one out around US here. What data from the federal government is missing that would help you better understand climate risks to assets? Brianne, have you got any thoughts on that? Some better federal government data, or indeed?
I don't know if it's exactly better data so much as, put it all in the same format in one place and keep it updated, right? Like, I understand the way these things happen. They happen by, you get a grant and you make this fabulous website with maps, and it's wonderful. And the grant lasts 3 years, and now there's this skeleton, and then another group gets a grant, and then and so there's no integrated useful database, even for like the US, but also one for the world would be incredible as well. So I think it's more of a like data engineering challenge and less of a specific data. I'm sure there's also specific data that would be useful, but I think the most useful thing would be consistency and centralization.
Okay. Anyone else on that particular point?
I would jump in and add that it could potentially be useful to create scenario libraries. I think, Brianne, I really appreciated how you illustrated a point that I was trying to make, but perhaps too abstractly, that you have these um, cascading impacts beyond the envelope of a particular asset, right? And trying to quantify those is sort of a fool's errand unless you've actually been able to describe the event itself first, right? And what impacts could you reasonably expect to see from a flood event of a particular type in a particular location? And I think that the Federal Reserve, in the climate scenario analysis exercise that it did in the first half of this year in the US with the 6 largest banks, really, I think, kind of pose this question, right? If you have a particular type of event, how do you then assess the impacts of that event on your portfolio, and kind of leaving it a bit, in some respects it was very well defined, but in other respects the question can be open-ended, and how you choose to construct the scenario around what those impacts are, at the system level, right, or at the region level, beyond the envelope of the asset, is really important. And the NGFS, the Network for Greening the Financial System, has recently picked up on this and begun to develop, or at least request us help to develop short-term climate scenarios for things like stress testing and scenario analysis. And I think that's potentially a really big step forward. And I don't think that burden lies solely on the US or the US government, but it would be great if there were more resources put to that.
Yeah. No, I think that's right. I think just staying in the US for the moment, are any of you incorporating into your asset level impairment projections the impact of insurance price rises and affordability, more, particularly premiums for NFIP or private insurers? Is that something you're taking into account currently, or plan to in the near future?
Yeah, it's been something that we've been exploring. We're not on the physical risk team. We're not working on that specifically, but we are looking at, we want to understand better the, commercial, the CMBS and RMBS system, and just mortgages in general, and that we're assessing as like a regional risk. Rather than like an asset level risk, like understand the regional exposure to climate hazards. But we haven't actually, it's something we're just exploring right
now. Okay. And anyone else? It sounds like it's at the exploratory stage from what I've understood more generally. Anyone else going beyond that currently? Okay. All right. Well, I'm going to ask, given the time now, each of you to wrap up. If there is anything you'd like to say to wrap up, I'm not going to attempt to summarize what we've just been talking about for the last 50 minutes, partly because we've had a iterative and rambling discussion, but deliberately so. It's been really interesting. Thank you. But if there's a sort of a final statement each of you would like to say, whether it's food for thought or whether it's a plea for better or different data to help you better in your businesses, then please, now's your opportunity. So whoever would like to go first, please jump in.
Well, I'm happy to make a quick, hopefully reassuring remark to the audience about not taking away from this discussion sort of anguish and analysis paralysis, right? I think that just to reiterate something that a number of us panelists have been saying, that there's a lot of opportunity for incremental improvement, even in the absence of perfect databases, perfect tools, and robust internal teams within your organization that are able to sort of run, jump, skip, and sing, as you were saying, Stuart, and that starting small with things like materiality assessments and heat maps, and trying to sort of understand and rank order different perils and map them onto portfolios is a great place to start. And that can be an incremental step towards this much more granular and rich understanding of flood perils of various types and their impacts. And it's not all or nothing, right? There's a lot of very important work that can be done in these incremental stages that is really critical towards better understanding these risks.
Great, thanks, Andrew. Anyone else? Brianne?
Sure,
Julian?
I'd be happy to say something. I think I said in the planning call to make you guys have even more on your minds. I do think it's worth, whenever you're talking about flood risk and pricing, to consider that there are socioeconomic variables at play here too, right? People who are in floodplains are often of less means. And so just be aware of, what's going to happen with the data and the processes you're putting in place, and how that might influence things outside of just purely flood risk.
Absolutely, thank you. And just on an aside there, we'll follow up in the sort of follow-up email to that with a link to a paper one of my colleagues, Dr. Oliver Wing, wrote on that very subject, about inequities of flood risk in the US. Sam, any final words from you?
Yeah, I just wanted to echo what Brianne said, and also, mention that we are improving our abilities to quantify these flood risks. I think it's also important to talk about the mitigation opportunities that we can implement. Smaller scale neighborhoods, cities are trying to improve these impervious surfaces and trying to add in more green spaces and think about this in a more holistic way. And also that beyond the long-term scenario analysis and climate data, I think it's important to talk about this idea of continuous monitoring and understanding real time what is happening and how to mitigate that with good local systems and people in place.
Thank you, thanks, Sam. And Gillian.
Yeah, I think you guys all said it. I just want to echo sort of what everybody said. Sam had mentioned adaptation methods like, a holistic approach where, you don't have as many impervious surfaces and you have natural ways to catch the water. That's huge. I think also what Andrew mentioned earlier when he said, incremental steps, like there's a lot of data out there, and just sort of combining what you have and making sure that you're informed about the assets that you hold or the investments that you hold, and understanding risk, even if it's just at a regional level, like anything to get you started on the journey of understanding your flood risk.
Great. All right. Well, thank you. Thank you very much to our panelists for your fantastic, insightful contributions, and thanks to everyone who's for your attention and various questions throughout the webinar. If you found this interesting and you want to hear more, then obviously we'll be sharing a summary of the key points from this. I don't envy the person who has to pull that together, but there's some really interesting stuff that came from it, and we'll also, within that summary, try to pick up and answer some of the questions that were posed that we didn't get a chance to answer. Please also keep an eye in your inboxes for a follow-up webinar that we're running at the same time on the 30th of November, specifically relating to climate data. And finally, if there's other events in future you might be interested in, look at the Fathom events page on our website under knowledge, where you can also dig into previous webinars and see the recordings of those, and get a bit more in-depth knowledge around the process of flood and climate data creation. So with that, no more from me. Thanks again to everyone, and have a good rest of your day. Bye-bye.